So, all right. So to introduce myself, I'm Mike Kozak. I cover metals and mining at Cantor Fitzgerald, and just a bit of a background. I mean, I've been covering the gold and silver names and the royalty names for 14 years now. And one of the things I've learned over that time is that the royalty and the streaming companies almost always outperform their operating counterparts, like the gold and silver miners, and usually over enough time, quite substantially so. So, over my career, I've always preferred the royalty and the streaming names as opposed to the operating counterparts, especially for generalist investors. The simple reason why that is, and Brett, you'll go into it in more detail, but it's because for providing the upfront capital, you get the NSR or a stream on a mine or a project, which gives you the gold or the silver exposure, but without actually having to take on the risk of operating a mine. And then also you get all the exploration upside and mine expansions, new discoveries. You get all that for free when a deal is good. So that brings us to Metalla, the company's founder and CEO, Brett Heath. We launched coverage of Metalla back in June with a buy rating at that time, and the stock's up 50% in a few short months here. But there's clearly a path higher. With every deal that's done that's accretive on either NAV or cash flow, or ideally both, that target, the NAV and cash flow moves higher. So, they've had a great track record so far of transacting on accretive deals, and hopefully that'll continue. So, Brett, why don't I hand it off to you? Give a bit of an intro on yourself, the company, then we can just have a chat.
Sounds good. Thanks, Mike, for that good introduction. My name's Brett Heath. I'm the CEO and founder of Metalla Royalty. Started the company back in 2016. We've built the business off a strategy of acquiring existing royalties. So these are royalties that have been created before. They're held by a very wide group of holders, from big corporates down to individuals. And we've built our company off a platform, and targeting these types of assets, it has allowed our company to focus on much higher quality counterparties and much higher quality assets. The big, large, multi-billion dollar major mining companies, they're never going to finance a project via royalty or stream. They have access to capital. They have access to very attractively priced capital. And we wanted to create a vehicle to give investors that type of growth that they get with these royalty companies, especially a junior company, but from a risk-adjusted basis of being much more attractive than what you traditionally see in the junior royalty business. Because if you look at our portfolio, we're targeting assets that are being built by the largest and most successful mining companies in the world. And we're also targeting assets that we know are going to experiencing a tremendous amount of growth on these properties over this cycle. So it's now at a portfolio of 50 assets. We've done 18 transactions. We've deployed upwards of about $100 million. And we believe that this gets us to, or where we are today is really this beginning of kind of the second phase of our growth evolution, if you will. We now have the scale. We now have the liquidity. We are now trading on the New York Stock Exchange. We have a track record of 4 years where every single holder that we transacted with that took back equity has made money, which we're very proud of. That's a difficult thing to do, particularly with the first couple years in this business. It was actually a pretty fierce bear market, at least with the junior gold and silver companies. So this is something that we've been able to do. It's it's a growth by acquisition business. We've got a laser focused strategy to do this, and we've been able to continue to execute in what is now I would say fiercely competitive environment, given the success that Metalla and a couple others companies have had in the last few years.
So maybe that's a good segue then, because you touched on a bunch of points there, but two that I want to drill down more on is that we're no longer in a bear market. We're in a bull market for gold. So all of these explorers, development stage companies can raise equity, which on one side makes it harder for you guys, and by the same time, you've had an explosion of small cap precious metal royalty companies now come on in the last year or two. So it's gotten much more competitive. How does Metalla, what's your competitive advantage in this new environment?
Well, so Metalla actually has a very strong competitive advantage. And I would say the biggest part of it is a first mover advantage. See, we're targeting royalties that exist. So we know all of the where the traditional royalty companies, they may be able to see out 12 months in regards to following different projects through their de-risking profile until they grant that investment in exchange for a royalty or stream. We know everything we want to buy for the next 5 years because it's all there already. So we've got that big benefit. Now, the first mover advantage is that the more valuable royalties in the list. So there's obviously on the lower, the royalties that don't have a huge dollar amount in regards to kind of the total size of the transaction. There's lots of those that are available. They're highly accretive. We'll continue to do that. But as you move up that list, the royalties that are there are more well known because these are big royalties. They're on big projects. Operated by very large companies, and our much larger predecessors have been trying to buy these royalties for decades.
Okay.
So the advantage that we have is that our ability to show 18 different case studies and really build relationships with these holders over the last 4 years. The holders of these royalties are comfortable with our management, comfortable with our model, they're comfortable with our ability to execute. And now that we're on the New York Stock Exchange, now that we have, we've been trading $5-10 million a day sometimes in liquidity, we're able to make those transactions. We're able to take those and engage on those, and where the new companies that are just coming in are going to have a tough time because they're going to have to do what we did over the last 3-4 years to be able to transact on those types of assets.
So you mentioned you have a list of royalties that you, perfect world, ideal scenario, you'd be able to acquire. Are those more weighted to like development stage? Are they cash flow generating now, or is it just a fairly equal mix?
It's a mix across the board. We want to buy assets that are accretive, that we know are going to experience a high amount of growth. And so sometimes that's exploration, like we saw on the Cortez royalties that we picked up earlier this year. And then sometimes it's more on the development side, like for example, the Fosterville deal. That we picked up that royalty. I mean, this is something that we believe is going to be producing cash in the next 2 to 4 years for the company. And then there's ones that are just producing, like the Wharf deal as well. So it's really across the board. I mean, what I would say is that the big royalties that are producing are obviously probably a little bit higher up on the list in regards to the cost than the development ones. I mean, there's been less of a focus of the sector in general on development royalties, and that's where we found just such amazing assets, and that's where we decided to go and really build out our portfolio based on a very solid group of development assets.
Yeah, maybe I think we touched on this on our last call, but I thought it was a very interesting point. Maybe you could just talk a little bit more about how, because I mean, like that Fosterville mine has been arguably the best success story in the gold producer space in the last number of years. And here you guys come in and you pick up some very prospective ground to the north and to the south there. And what is it? Just a very, it was a highly visible deal, and it was, you can tell in your share price, right? That was the most recent leg higher. So maybe you could just give a bit of background on how that came together. So I think it kind of, it's a demonstrable example of how you really do the deep dive at the asset level.
Of course. So this was a royalty that was held in this company since the 1990s. And it's now a gas company in Indonesia, but rewind 30 years, it was a gold exploration company in Australia. And a long time ago, that company sold that asset, retained a royalty to what is now a subsidiary of Kirkland Lake. And they've held it, and they've held it this whole time. And so, you know, through our relationships and through our database, we're able to build up, you know, after contacting the individual that controlled this royalty, we're able to build up a relationship with him and show him what we've been able to do in regards to maintaining the exposure. Because that's the biggest thing, is that no one approached him prior to Metalla with the ability to be able to get liquidity and maintain exposure to the royalty.
Okay.
And so we've been able to do that with our platform, build a relationship with the individual, and then we're able to transact on it. And we're able to transact on it bilaterally, which I think is amazing, given, you know, as you noted, given the profile of this asset. You know, this company decided to transact bilaterally with Metalla, and that's what, again, gives us, I think, an amazing competitive edge on being able to continue to bring in just some really incredible assets that have a huge amount of optionality for our shareholders.
Yeah. Okay. Do you think, I mean, with the number of new royalty companies that have come on in the last year or two, do you think we're going to get to a point where there's consolidation, like M&A within the royalty space? Like we saw, I think last week or 2 weeks ago, there was Nomad that bought Coral Gold.
Mm-hmm.
But other than that, I can't think of any recent transaction where two royalty companies. Do you think there's going to be consolidation, or it's going to stay kind of fragmented like this?
I think we will see consolidation. I think we'll start to see a more material amount of consolidation, not just with the small companies. I mean, Nomad's business model was to kind of start to consolidate some of the smaller royalty companies.
Yeah.
Which I think is needed as well.
Okay.
And there's plenty of opportunities for them to do that. So I think they'll be successful consolidating up a lot of the smaller royalty companies. But I think over the next 12 to 24 months, we're going to see consolidation with the bigger companies too.
Really?
There's too many royalty companies that are out there. The big companies, they've been frustrated. The reality is that they've been frustrated because the competition at the larger levels, the returns just aren't there anymore. And you know, the companies like you know, Wheaton and Franco, which are the biggest, yeah, you know, they're fine because they're competing with the GDX or the GLD, and they're trying to pull capital away from the big ETFs, which I think is the right way to do. And they're so big that they're more of treated as a proxy on the gold price rather than kind of a high growth vehicle. But for the ones below them, you know, there's not a lot there for them to do to be able to kind of continue on that growth. And so as we move further into the cycle, I think that's when we're going to start to see the M&A. And I would not be surprised if we see it start within kind of the next year.
Okay. And then maybe changing the subject a little bit, but it's one that could be a very large catalyst for Metalla. Is, you mentioned U.S. listing, dividend, good trading liquidity, 400 million market cap now, thereabouts. What do you have to hit to be selected for a GDXJ, as an example, or some of these indexes? Because I mean, that could potentially be millions of shares to buy in past.
Yeah, so that's a very good question, and for keen investors, the next 3 months is going to be the time to build the position. So the way that the ETFs and the indexes decide to put which companies, you know, bring on or out is based on two metrics. It's market cap and liquidity. So they need to see both of those requirements maintained for 2 consecutive quarters. And once they're maintained for 2 consecutive quarters, then that's normally when they bring you in. And where we are today from where Metalla is, we will have, and I believe we will continue to meet all of the requirements for all of the ETFs and indexes up to, the only one that will be missing is GDX, because that's the big one.
Yeah.
But GDXJ and down, you're looking at about a half dozen ETFs and indexes that we think will likely add Metalla starting in January, which is going to be a huge tailwind of buying, and also it's going to increase the liquidity even further. So that these 2 quarters, the second half of calendar 2020 is where we have now met all of these requirements.
Okay. And then maybe, I don't know how much time we have left, but maybe just to close it off, can you just walk us through, let's excluding the potential index inclusions, what are the next catalysts? There's cash flow from Wharf Mine, Santa Gertrudis, there's Nevada Drill. What are we looking for in the next 3 months?
So, first off, on the acquisition front, we're going to continue to be very active. I believe that the transactions that we've been building the company to do will likely happen over the next couple of years. So then it's not too late. The biggest and best deals are probably in front of us, not behind us. So that's kind of first and foremost. Internally with the company, Wharf already started cash flowing for us, so we already got that check, and that pays monthly. Joaquin and Cozy also are kicking into gear in calendar Q3 of 2020, so that's going to add another nice bump in the cash flow. We've got a number of projects that we think have a very high probability of some exciting exploration, which I think mainly would be the Cortez assets, the Red Hill and the Anglo-Zeke, which is Nevada Gold Mines, and a junior called New Legacy, and then also the Fosterville deal. The Fosterville property that we have, particularly to the Harrier deposit. Keep an eye on the Harrier deposit. We think that there'll be a significant amount of drilling over the next 12 months on that property too, and I think we think it'll show some good results.
Okay, good stuff. Yeah, how's everything? How's the business operating with COVID? I mean, you guys, that's the other thing with the royalty companies, is that everyone can kind of work from home because it's such a lean team.
Yeah.
Right? Yeah.
I mean, we were set up for this before it happened, because I'm out in California, and we've got our corporate office with our CFO in Vancouver, and like our back office employees there. And then we've got our corp dev team in Toronto. So we're spread out all over the place. So it was kind of business as usual for us. It's a little bit more difficult to get the transactions done, to not be able to move around and be able to meet with the people or do the diligence kind of on the ground that you would sometimes be able to do. Just given the travel restrictions or delays and everything like that. But for the most part, what we're seeing is exact opposite of what the sector is experiencing right now, because the traditional royalty and streaming model of providing capital to mining companies is significantly gone down, because the mining issuers have access to cheap equity, where because we've been targeting existing royalties, these royalty holders are now much more engaged because they want to be positioned before this bull market is in full swing. And so there's an urgency that we're getting right now on the transaction front, where you listen to some of the big royalty companies, and they don't have to be high growth vehicles because they're already so successful and they've done extremely well. But from comments that we've heard from the big royalty companies is more along the lines that it's becoming more difficult as we move further in the cycle, because equity is available to the mining companies at cheaper prices.
Yeah. Okay. Interesting. Okay. Well, I think that's a good place to leave it.
Yeah.
Yeah, look, I mean, you have a great track record of accretive deals. Your share price is reflecting it. So just keep up the good work.
Thanks. We will do so for sure.
All right, sounds good. Take care,
Okay,
Brett.
thanks, Mike.